Everyone, and welcome to the NCI CreditWise Academy Seminar Series. This is our third of three, and thank you for joining us again for the third seminar. Today, we're sort of wrapping everything up to our holistic credit solutions. So we've looked at the number of stages of credit, and today, with a particular focus, is on how the recoveries can work and how basically to get paid. All right, so more than ever, credit professionals are even more important. Given the current economic cycle and where we're at, making sure that a business gets paid is really, really critical. So that's why we're focusing today on the recovery cycle and making sure you're getting paid. Now, just a reminder, make sure that you put your questions in the chat box, and at the end of this seminar, we'll ask those questions, or Prudence will ask those questions to me, and we'll hopefully be able to answer any queries that you have. So I'd like to welcome my co-presenter today, Prudence Chang. Welcome, Prudence.
Thank you.
All right, I'll hand over to you for the next slide.
Absolutely. Thanks so much. And thank you for everyone for joining us today. I'm really excited because I've seen a lot of you out and about at different conferences recently, and I know we've had some great feedback. So thank you very much. And we do find that feedback very valuable. Of course, these are aimed for you. We write them in a series of understanding where you guys are at and what you guys really need to know about. So if you do have anything else that you would like us to present to you or find out further information about, please do let us know. Now, in recap of our last seminar, of course, we discussed what we really need to get in regards to security. So this really entailed the differing types of guarantees, which ones were suitable for your business and which ones would be worthwhile, and really understanding the wording around it. We also discussed the PPSR. And of course, it's been the bane of most people's existence, certainly mine, but it is something that we need to know about and we need to be registering correctly. And I guess correctly is the word that I'd like to highlight in bold and underline, because I'm still speaking to people that have registered under incorrect entities, which can, of course, pose a massive problem in regards to getting your goods back if they're left on the floor, or having that right to really discuss the matters with the insolvency practitioner should it get that far. The other thing we discussed was the importance of monitoring. So we discussed that a picture is taken of a debtor when you open up an account. And that picture can, of course, change over time. And making sure that we have the correct mechanisms in place to be monitoring that debtor when the picture changes on a day-to-day basis. I only was out to a client this week, Kirk, you won't even believe this, who said to me, oh, we've opened up these accounts. And then I looked at the ABN and the ABN actually wasn't registered anymore. It happens a lot. And it's something that we really need to be monitoring and be making sure that we are watching those debtors for change, because unfortunately not all debtors are going to let you know when they are changing their company structures. The last thing that we really discussed was, of course, trade credit insurance. And we will go through that again at the end of this slide, but really discussing that that is the ultimate protection, of course, in the event of non-payment or insolvency. So as Kirk said, customers unfortunately don't always pay. We would love them to, but it's just not in their nature to always be paying or be paying on the same time every single month. What does that mean for a business? Well, it can be, of course, very, very costly. We know on a 10% margin, a $100,000 bad debt can cost a business up to $1 million worth of sales to recoup that loss. Now, I'm sure you'll all agree with me that we don't want to be working for X amount of months to create this $1 million worth of sales for free. And that's really what it comes down to, is that if we're not collecting our money in a timely manner and we are not protecting ourselves in the event of these things happening, we're basically working for free if we're going to lose some money. So we want to be putting these mechanisms in place to make sure that you guys are in the best financial position, and you are also in the best position to negotiate with your debtors. The sales, of course, required to recoup the lost money, as I just said, up to $1 million on a 10% margin. It's a lot of work. And I'm sure you'll agree with me, that's only the dollar figures, let alone the mental strain that it can cause businesses to be recouping this money. Can the business meet its own financial obligations and pay its creditors if they fall due? So this is talking about your cash flow. Does this mean that if you can't plan for growth? Of course it does. If you aren't receiving the cash flow that you would normally get, it does stifle the business in regards to really concentrating on how we are going to grow moving forward, feeling comfortable with the business, and of course those stresses goes up. The domino effect is something that we need to be clearly aware of, certainly going into the changes in the economic climate in the next 12 months. We know that there's pressures on businesses to be repaying the taxation department, and we know that the taxation department will be a lot more vigorous in the way that they are actually collecting this debt, and a lot faster in making decisions on what they're going to be doing with people's businesses who aren't paying back this debt. This does mean there is a domino effect that could arise where your debtors could be under financial strain that you don't know about. So again, it's not always their fault that they can't pay, but simply they're unable to due to not being paid by their debtors. Again, these are things that we may not be aware of, but we can put mechanisms in place to safeguard us from these situations.
Thanks, Prudence. So you would see at the moment, lots of people recognise that there's a lot more insolvencies that are happening in Australia, and therefore, like I mentioned before, credit professionals are even more important out in the marketplace at the moment to make sure that you have robust mechanisms in place to make sure you've got recovery processes in place when these events happen. You can see during 2024, there definitely has been a big uptick to the point that we're actually at record levels of insolvencies occurring since we've been keeping records. So it was sort of expected. Obviously, during the COVID period, we had minimal insolvencies. So there's definitely a catch-up happening. And as Prudence said, with the ATO and other actions coming into play, definitely there's more insolvencies happening and more businesses are under pressure. So let's just quickly talk about the types of insolvency that can happen. Many of you would be aware of this, but I just want to quickly touch on them because it does change perhaps the way that you have to go about the way that you will deal with recoveries in these individual events. So first up, voluntary administration. This is where directors effectively put themselves into administration and appoint an administrator. And then the administrator's role is to whether to look at a deed of company arrangement can be entered into, or the business needs to be wound up and handed to a liquidator. A liquidator, well, if they're appointed straight away, well, that means that either the business owners or a bank or a court has appointed a liquidator, which means they're there to basically shut down the business and try to get as much as they can for the assets to repay secured creditors and unsecured creditors. Typically, we see not much return in those events. A receivership. So with receivership, this is where there is a receiver appointed on behalf of a secured creditor. And that normally leads to some sort of restructure to make sure that assets are resold or sold to satisfy the secured creditor's outstandings. A deed of company arrangement. Again, this is where a administrator comes in. They look at the business. They feel that there is a good prospect of the company surviving, and typically you'll see a deed put to creditors, and the creditors have to approve a deed of company arrangement, which typically will pay around 5 to 10 cents in the dollar if you're lucky into the future for the business to keep going. A provisional liquidation is a court-ordered process to protect the assets of a business, to make sure if there's disputes that are currently in place, that a liquidator can come out and sort the disputes out of the business, and again, either decide to wind up the business or find another restructure for it. And something that's been happening more and more in the last year in particular is the small business restructuring. So this allows a simple process for a smaller business to look to restructure its debts by proposing an arrangement to its creditors within 20 days of that restructure. And during this time, the directors remain in control. And typically the debts outstanding have to be, or they do have to be, less than $1 million. And they have to use a restructuring practitioner, which is either one of the insolvency practitioners, or it can be an accountant to sort that out. Each one of these events are an insolvency event, and therefore the way that you, as typically an unsecured creditor, needs to then take action is the key to the whole scenario.
Thank you, Kirk. So we just wanted to go over some early warning signs and some things to think about. Now, when we discuss these, it seems very simple, but these things can, of course, go out over a long amount of time. And it really does depend upon a few different things. Firstly, of course, the customer isn't paying. This can, of course, be the first sign that they are struggling. But we really need to go into a further communication with the debtor about this. And I always say to people, if they're open to having a communication, you're going down there and going through the doors and having a chat with them in their premise, it's always best. Of course, this does level up the honesty and trust within the relationship. And like all relationships, that's what this really comes down to. We also want to be seeing, of course, you entering into repayment plans of some type. We want to draw down that debt that is obviously out there. And this really leads on to, are they going to adhere to this repayment plan, or are they going to provide us with excuse or failed promises around that? If they are, that is again a huge red flag as to what's going on within that business, and are they financially healthy enough to be working with you or to be actually repaying that first initial payment plan. I have had situations where I've spoken to debtors about their repayment plans, and they've actually said to me, look, I know I was on $5,000 a week, but I actually can't pay that back. I can only pay you two. And if I hadn't have asked that question, well, can you pay anything less? We wouldn't know. So sometimes it's really good to have that further conversation about the repayment plan if they aren't adhering to it, or they are failing to make, of course, those promises they've made. Change in purchasing behavior is something that I think is really, really important. A lot of debtors and a lot of businesses will pay their creditors on a certain day of the month or a certain couple of days of the month, because that's when they are actually doing that particular process. So it is important for us to note when that process does become adherable to that particular debtor and what you're actually doing about it. If they step outside this, it might actually be a change in behavior. Now, of course, as we all know from running businesses, it could be a change in process, but it could also be that they're not financially secure. And that is something that we need to be aware of. This all comes down to communication. By picking up the phone and talking to your debtors and really understanding their position, hopefully you won't be caught with any of this moving forward. But if you do, it's important that what I call the brains trust is working within the business, that accounts and sales are working together to really understand what's happening with that debtor, and also understanding what their purchasing is like moving forward. Is it a fact that they need to purchase some more things to manufacture something and then be paid by another debtor? Is it a paid on paid contract type of scenario? And what does that then mean to your cash flow and how you're actually dealing with their debtor as well? All of these things provide us with early warning signs as to what we need to do on our side to work best with the debtor in making sure that we're drawing down that debt, of course. Now, Kirk's going to go through some really, really interesting matrices now on how to escalate these situations.
Thanks, Prudence. And just as a reminder, if it's not in writing, it never happened. So
Right.
make sure that you are entering into a repayment plan, even just confirm back in email to them, and also confirm that they're not disputing the debt. It's really important when we're having discussions down the track with any collection action or recovery action that they have at some stage said, look, we asked for green apples, you sent us green apples, we're not disputing the debt at all, but we just can't pay it in full at the moment, and then reconfirm what they are willing to pay back into the future. It's really important when we get down the track that they haven't disputed the debt. Now, as Prudence mentioned, we wanted to give you a tool on a typical sort of scenario where we have a matrix that you can take away and use. Here it is. It's based on a 30-day term, so 30 days from end of month terms matrix. And throughout our 40 years in history in working in the trade credit industry, this is a typical process that people are going to follow and is a common practice in making sure that they have steps in place in their business to effectively recover any outstandings, or have a plan written down to make sure that they're going to follow these rules in the event of an overdue payment. So there's plenty of of software available out in the marketplace to help automate all this as well. NCI has a product called Easy AR that, based on your rules and your wordings, you can automate these letters at these various timings that you're going to be sending out to your debtors to ensure that there's no disputes and that you can effectively manage your book of recoveries with your debtors. So the aim is to make sure that you save time and get paid faster. And we would suggest that this is best practice, this matrix, in the way that you would chase up a customer if they fall behind you. So let's just look at it on a step-by-step manner. Obviously, you're invoicing or sending an invoice, and that's day zero. You're telling the customer, hey, we've delivered some goods. Here's the invoice. And you need to make sure on that invoice there's the correct details, such as when they need to pay. So make sure it has your terms of payment on there. It's going to have perhaps some of your terms of trade on the back of it. And it's going to have the correct legal entity that you're trading with on it, because we'll rely on that into the future. If an insolvency happens, we need to have proof of delivery or a copy of the invoice. So we find that it's best practice to avoid these disputes or avoid any issues with an invoice, to send a friendly reminder before it's due. And this is payment reminder 1. So let's take the example at the 25th day since invoice, you're going to send them off a little email or a notice that says, hey, by the way, just letting you know, there's an upcoming due date here. This is the amount we're looking for. And that gives them the opportunity to dispute something prior to the due date. If they are disputing something, maybe it's a delivery fee, maybe the pricing isn't right. How many times do we see a scenario where the client just doesn't pay, or the customer doesn't pay? You ring them up, 5 or 10 days later after due date, and they say, oh, no, I've got a dispute with that invoice. I didn't agree to the pricing or whatever. And that is just going to delay things by another 15 or 30 days before they'll pay their invoice. So if you can clarify anything prior to the due date, that is now a very easy process to do. And these software automations in particular can do that to make sure that you avoid any of those disputed problems before due date. So then when the invoice is due, so you expect the payment and your terms are 30 days. So you're now monitoring for that payment, and your system can alert you immediately if they haven't paid on time. So then look at payment reminder 2. So this is post due if you haven't received payment. And again, some of our clients send it on day 1. Some of them send it 5 days after. Some of them might send it a week after. We tend to find that a nice friendly reminder, whether that's an SMS, an email, or a customer call saying, hey, we noticed you missed the payment. Is there any reason for that? It was due. When do you think it will be paid? That's the first sort of friendly reminder that we see going out. Then, based on your rules again and your payment terms, there's the next level of follow-up or escalation with a little bit more of a firmer tone at day 45. Basically saying, hey, this was due. You're now overdue by a couple of weeks. We need that money. You obviously have suppliers or your suppliers that you may need to pay. It's starting to affect your cash flow a little bit. Hey, what's going on? We need this. Your payment's due now. And then again, based on your rules, if you get no reply or no satisfaction there, then you send the next level of escalation. And that might be, hey, you're now 15 or a whole month overdue. We're going to need to escalate this. This is our plan of attack if payment's not immediate. Just letting you know, you might remind them that it's in your terms and conditions that this was going to happen if they didn't pay on time. And especially if you're getting no communication at this stage, that's when that automation starts to happen, being a little tougher. So then it gets to 60 days overdue. So now you're getting a little unhappy. It's starting to affect you even more. There's been no communication or way they'll refer it or the way that they're going to repay it. So now you're going to refer it to legal or collection, and you're telling the client, hey, I'm sending this out. It's going to be referred or transferred to a debt collection agency or legal partner. And by the way, based on our terms and conditions, you will pay the costs relating to that collection action. And then if we have no response to that, hopefully there is, but the point when it gets to 120 days or plus overdue, that's when it's going to really start hurting your P&L and starting to having to provision under expected credit loss, or your own internal procedures. You're going to have to start writing down or provisioning for this debt. And that's where you might have to say, this is fully in the hands of the collection agency now. And you might go a little bit tougher with a demand letter or even a wind-up notice. So I hope that tool's been a little bit, well, it's been useful for you. That is typically what we see a customer or many of our clients do, and they set these rules. They let the whole company know that these are the rules that will apply. They keep it up on their workstation, and this is what they'll do in the event that a debt becomes overdue. And we find it's the most effective way and the most, I guess, comfortable way in dealing with a customer if they're not paying on time. Prudence, what's a standard sort of letter look like if they're not paying?
Yeah, absolutely. Thank you so much. So before we get into the standard letter, I just wanted to tell you a little bit about collections. So I'm sure you guys all know about collections companies. You know, they're an external body that you usually enter into when you have had enough. The thing is, they can also be really valuable when you haven't had enough. So what I mean by that is that sometimes a debtor just needs that extra push. They need that push from a third party. It's not that you want to sever the relationship. Of course, there are some circumstances where we do want to sever the relationship. I'm not saying that we don't, but under the circumstances where we want to keep that friendship going, sometimes a third party entering into the negotiation can help the situation. They can massage through the right word track to make that debtor feel more comfortable in going into whatever you need them to do, whether it be a repayment plan or maybe they need to be on stop credit and repay what they're doing right at the moment. So a third-party collections company can be utilized in many different fashions. And what I say to clients when they are asking me about where should I inset this, where should I put this in the process, I look at it in an individual and bespoke manner. So if you have a debtor that you know is historically not paying on time, but you do know when they do pay and they fall outside of that, maybe it might not be wise to take them to collections because they have educated us almost as to when they're going to be paying. But in the scenario where, you know, the communication gets turned off and we're not hearing from anyone and they're disputing every single debt, it might be best to hand it over to a collections company so that then you can pull yourself away from the situation and you can concentrate on what you want to be concentrating on within your actual role. Typically, what we see is collections companies being engaged in anywhere between 60, 75 days, as Kirk said, right up to 120 days. Again, it depends on the situation, and I would always look at it in a bespoke manner. Legal considerations are, of course, really important as well. Having a third party, being the collections company, enter into these negotiations means that they will be abiding by the ACCC rules and regulations, which can be quite tough to navigate. It also means that, of course, all of their documentation will be right and ready if you do need to go to court and if you do need to have further considerations made. Strong documentation will strengthen your case should the court proceedings have to occur. And this is, of course, access to expertise and resources. The collection guys that we have in our team, they can certainly organise, negotiate, and they have different wording available depending on the situation, and that may help the negotiations. So I always say look at it in a bespoke manner, but certainly third-party collections companies are very valuable if you want to step away from the situation. So the next slide we're going to go through is a typical demand, a typical collections letter that we would send from NCI Collections. And this can be sent, as I said, whenever we're instructed to do so. But this certainly does increase the success in a smaller time frame as well, because sometimes, as I said, that extra push, and sometimes they might think, oh my goodness, this has gotten really, really serious. That's when I have to pay. And some people may trigger them to actually pay a lot earlier than if we were just having that conversation. As you can see here, what we've got here is the amount that we want to be paid. And of course, it's always in red. That flashing red sign makes us pay a little bit faster, hopefully. We've asked for it in 72 hours. We've said that the goods sold and delivered and the amount. We've said the collection costs. So this is a really interesting one to remember also. And we did touch on this on seminar one, which was credit application forms, making sure that your collection clauses allow you to on-charge any collection costs to that debtor also, which is really, really important. So again, they can see the collection costs. They can see how much this is going to cost them by taking it to a third party. And hopefully this means the next time this comes around, they're going to be paying a lot earlier because they don't want to have to be paying these collection costs. The total is there. And then, of course, we've got, of course, the bank account numbers to make it really easy. As Kirk explained, there's also those IT infrastructures that you can place that can log into your systems that also might be able to do this via an SMS. I know I get a lot of SMSs these days, you know, your hairdressing appointments here, put down your 100 deposit. We're used to paying via SMS. So it might be another way of you actually getting these payments through a lot faster is having that infrastructure in place. But certainly it's really important to be looking at this for all the reasons that I've just discussed. And it's helping finding those missing debtors also and making sure that we're having clear amounts of communication to them as well. Kirk, do you want to go through a little bit about PPSA recovery? I know this has been very topical in our past couple of seminars, so I think it's really important that we get into that.
Yeah, absolutely. So essentially, like we've said in the past, registering a security interest on the PPSR gives you a seat at the table, either pre or post the insolvency of one of your customers. Pre, because you're going to be able to say to them, hey, I've got retention of title within my terms and conditions. You've not paid me. It's now overdue. I want that stock back. I have the right to come and grab it. And by the way, I've even registered this security interest. So I know the title is still mine. It's not paid for. So we're going to come and grab it back. That typically doesn't happen a lot, to be honest. People generally will leave stock there and recover it in a different way later on. But typically, what we see is when there's an insolvency, that's when it gives you a better seat at the table. And when one of those insolvency practitioners needs to sit up and take notice that you have a registered security interest. And again, I'll just make sure that you are fully aware that it needs to be a properly registered security interest through the template or the right entity details, the right description, all of those things that you need to have in place. But when an insolvency happens, we would suggest that straight away you're writing off to that insolvency practitioner saying, hey, by the way, I've got a security interest over the retention of my goods. Here's the registration, because the liquidator will look at and they will go onto the register to see who has a registration over that entity. And they're going to scrutinize whether you've done it right or wrong. So that's really important. Throughout that administration or liquidation process, essentially using a scenario where we've had retailers go broke before, typically the administrator or insolvency practitioner will want to continue to run that business for another 30 or 60 days until they get a handle on what they'll be doing with the business. And they start selling the goods, or they continue to sell the goods. So as we know, once an administrator or liquidator comes in, they are responsible for the debts of that business. And we will be putting them on notice saying, hey, we want a stock take straight away. We want to know what stock's there. We think we know what stock's there. If you're not going to return that stock to us, if it is sold, there's an obligation to make sure you pay us for it. And that gives you a really strong seat at the table as a secured party to those goods. And again, what we've talked about in the past is the timing of this registration. And in-house expert Paul Miller keeps saying, don't wait to register your security interest. Make sure you do it professionally and straight away. Make sure your terms and conditions are right, and make sure as soon as you start trading or are about to start trading with a particular debtor, get that security interest registered, because it's going to allow you to have that seat at the table pre or post an insolvency practitioner come in. It gives you a much stronger position. I will also touch on unfair preferences. Now, whoever has had a preference action taken against you, it's really the bane of the credit world. It's not a pleasant experience. And again, whilst we're not saying that a security interest or a PPS registration is going to guarantee that you're a secured creditor, and they're not going to be able to take you for a preference action, it gives you the ability to negotiate and talk about yourself being a secured party. So just to run through quickly what an unfair preference is when a liquidator is appointed, it has to be a liquidator. They can go back 6 months of payments that liquidated company made to their suppliers and say, we believe that you were paid in preference of other suppliers or other parties, and we want those 6 months of payments back from you. And that's where the negotiations start. So if you receive one of those, that's a whole nother topic to talk about with preference actions, but we can help you through that process. We can make sure that you're writing back the appropriate letters, that you're highlighting that you're a secured party, all those things that are going to make it more difficult for a liquidator to continue to take the action, because they will have to prove that you weren't a secured creditor and that you didn't have security. So again, don't wait to register your security interest, because as part of the recovery process, being able to present that document, being able to have the seat at the table with the insolvency practitioner, and whether you get your goods back or whether you get paid for goods that were sold in the process, that is going to put you in a stronger recovery position.
Absolutely. And the cost for PPSA, Kirk, it's really reasonable, isn't it? It's $10.40 to register for 7 years. And you think, to get that seat at the table, $10 over 7 years, I mean, madness to not do it. And that's what I say to all clients, absolute madness. So trade credit insurance, we've got a slide here about that, of course. So trade credit insurance is the ultimate protection. So say everything goes haywire, we've sent it to collections, we've got the most robust systems and processes in place, and you guys have done the best job possible. Unfortunately, we still can't determine and we can't confidently say that your debtors are never going to fall over. And, you know, your collections companies that you enter into, they can certainly help assist with legal matters. They often do have legal counsels inside them or are linked to legal counsel, so they can, of course, help in the recoveries. But what do we do in the event that there's no recoveries? What do we do in the event that there's no goods on the floor for us to obtain through our registrations of the PPSA? The ultimate protection is really putting in place trade credit insurance. So just quickly going over what it is, it's a risk mitigation. It's where you can get paid out up to 90% of the debt that's owed. And this can also cover preference payments if it is within the allotted credit limit. So depending on the situation is whether you would go in for a first claim and then possibly a secondary claim with a preference payment. Debt recovery. I really wanted to highlight this because it's something that a lot of people don't know, is that the insurers actually do have collection and legal reimbursement clauses attached to each of their policies. Depending on the insurer, it depends on the amount, certainly. So it can be anywhere between the $5,000-$6,000 mark right up to the $10,000 mark. But again, it's really interesting when we sit in front of clients, we go through how much have collections cost your business in the last 12 months? How much have legals cost you? And how much could we have actually gotten back should we have had a trade credit insurance policy in place? You may find that the scales are quite even, which even further demonstrates the use and the interesting fact that trade credit insurance can be used to recoup those costs with the debt recovery. And of course, it's there to help you sleep better at night, which is the most important thing. Recovery costs are covered with the trade credit insurance, and it is something that if you have never evaluated it within your business before, certainly do reach out to either Kirk or myself, your client service manager if you're already a client, or a sales executive, and we're more than happy to help you and to work out what the true cost of this policy is once we take into factor that the policies do cover legal and collection reimbursements.
Thanks, Prudence. So from your original chase up on an overdue debtor to try to recovery for collections, for recoveries through any securities, maybe a guarantee that you might have, maybe a cross-company guarantee, all of those things that you have done. At the last resort, the best safety net is a trade credit insurance policy to get that 90% on average back, that you can guarantee that if you've done everything right, in the event that a company becomes insolvent, then you've got that recovery at the last resort for you as well. So Prudence, for the last few months, we've had these various series, and what I'd like you to share with us is our top 5 CreditWise Academy tips through all of the things that we've just talked about over the past few months. Can you do that for me?
Absolutely. Although it was hard to pick 5 when you said pick
It
5,
was.
it's really hard
We might
because
we might have
there's
a bonus one as well.
I
So
know
here we
there
go.
was so much. So the first one is online credit application forms, T's and C's, or not online. Just make sure that you've got one in place and make sure it's legally sound. I went into a client not long ago and they hadn't actually changed their credit application form for over 10 years. Now, we all know that there's changes in legislation that happen very regularly. And unfortunately, our government bodies are not always best in telling us about what's going on. So it's really important that you are checking your credit application form to make sure that it is secure for you guys in your relationship with your debtor for both recovery of goods, your PPSA clauses, of course, and your collection clauses and charges to be recouped via the debtor as well. So you're not having to pay them should you not have a trade credit insurance policy. So the online credit application and T's and C's is the first big one that we've got to make sure is secure. If we don't have the front end secure, we can't expect the back to actually be workable through the process. The second one that we've got there is, of course, the credit assessment matrix that we went through. What are you actually doing to assess credit? Are we just looking at 3 trade references? And what's the weight behind that? As I say to everyone, you know, a debtor should have 3 people that they're paying. They should have 3 names that we can call up and we're going to have a really good conversation. But it's about what else is going on. Could we find out more information through an adverse report? Could we find out more information through a director's report? Could we find out more information by just talking to other people within the industry or our salespeople? So really looking at the credit assessment matrix that we have discussed in our previous sessions and understanding where that is placed within your credit processes as well. The third one is security. What security have we got in place? Do we have any in place? And is it necessary? So, of course, some security isn't going to be necessary depending on what you do, but there's a variety that we can look at. So PPSR, guarantees, so whether it be personal or director, and of course the trade credit insurance. What security can we wrap around this deal to make you guys more secure moving forward? And again, bespoke to each business, but it is really important to really look at and to make sure that all these things are in place to put you in the best position. Now, if we've done all of that, of course, hopefully recollections and payment automation will be easy to then push through should you need to at between that 60 to 120 day mark. The payment automation, as I said, it's really important to look at and to understand to see if that does bring down your daily sales outstanding figures to make sure that you are being paid faster. We want to make sure that the credit application form, as I said, is linked through and has the correct wording to allow us to perform those collection proceedings as best possible and to put you in the best position ever. And of course, the last one is recoveries. We want to make sure that if you are going to go down the collection route or if they do fall insolvent, what can we recover in the event of the insolvency? Do we have those securities in place to then recover through goods? Or, as Kirk mentioned, are we paying that $10.40 to have that seat at the table? Can we have that seat at the table? Can we talk to those liquidators about what's actually transpiring and what opportunities we have? Because we do know that there's some circumstances where we need to trade on for a little bit longer. So what does that mean? And how is that then going to affect the recoveries that you're going to get at the end of the day? So they're top 5 tips. But, you know, one more, here's my bonus one, is the monitoring and alerts. That is so important. If I could tell every client one thing to do other than these 5, it would be to monitor your debtor for adverse information. Let's look at them on a daily basis. You don't have to do it either. We can do it for you. We can send you those emails every single day, week, whatever you pick, to be able to be notified of these changes. It's so important that we are monitoring debtors because business The world is shifting so quickly. And if we aren't having this mechanism in place, you could be left. We could be invoicing the wrong entity for starters. You could find out that they have other failed companies going on. So does that decrease what you want to be doing with them because there's extra risk? Monitoring and alerts have so much value and weight. And that is certainly one tip that I think everyone should take away from today.
Thanks, Prudence. And the two tools that we've provided through this CreditWise Academy, especially the credit assessment matrix and also the escalation matrix once they are overdue. They're the two critical rules that I would say within the credit assessment or a credit professional's life, where these are the critical moments where you're saying, I'm going to assess the customer and make sure that they're good for the credit I'm going to give them. And I'm also going to have discipline and rules around the fact if they become overdue, I've got a playbook to tell me what to do. They're two key elements that I would think that would be processed there. Now, of course, NCI, we've put these CreditWise Academies on. All of these different elements, obviously NCI has a lot of experience in, and we can assist you with credit application forms or assessment of debts or information reports, monitoring, credit insurance, PPA registration, collection actions, all those things. So please, if you do need any assistance or if you'd like to review any of these elements as part of your credit processes, reach out to Prudence and I or someone at NCI, and we'll be more than happy to look at it in a bespoke way for your business on what you would do. We've been doing this for years. I think between us, Prudence, we've got over 58 years experience. We don't look like it. And we'd be more than happy to help you and your business look at those elements.
Absolutely.
So that sort of wraps up our CreditWise series. There's a couple of things I'd like to highlight here. First of all, thank you to you, Prudence, for all your time and effort and being my co-host here in these seminars. I'd also like to thank Sarah DePero and Daniel McIntosh in our marketing team who have put all this together and helped us through the research and putting the expert slides together. So thank you very much. The people who have been watching these series, over the next week, we will send out a follow-up email with the information that we've presented in this particular seminar, Seminar 3. So you will get a certificate and you will also get our PowerPoint or presentation or information from this seminar. So stay tuned for that. We'll also be asking for a feedback sheet, and we'd like to run these seminars again in 2025. So if you have some tips or topics back for Prudence and I that you would like to see next year in a series, then please give us that feedback and we will be more than happy to touch on that next year also. So that's about it from us. Other than, do you have any questions for me, Prudence?
We've got quite a few that have come through. Thank you so much for everyone that has put through some questions. I know some of them we have answered, but I've got some really interesting ones here, Kirk, that I think that will be very valuable for our community. The first one was asked about in regards to seeking credit limits with insurance companies after they have appointed liquidators or they've gone into new, I suppose, company arrangements. Can it be done, and what does that actually look like?
Yeah, absolutely. Good question. And it's one that gets asked a lot. So essentially, as I mentioned, the administrator typically, if they're going to, whether it's voluntary or court appointed, if they're going to trade that business on, they then actually become the owner of future debts and risks. So they are the ones that we then need to apply for cover on. So it might be KPMG as administrator for ABC Proprietary Limited. You can apply for a credit limit on that. You won't be able to rely on your discretionary level, so you will need to get a credit limit, and NCI or your broker will go and negotiate with your insurer the ability to continue with trade under that company. And if the administrator or liquidator or whoever falls over, then you're insured for that risk as well.
I think it's also really important to remember in those discussions, insurers do want you to continue to work. they want us to lower the debt levels. So the support that they give you and the information they give you in these scenarios can be very, very useful for you making further decisions also. So Kirk, when a company does enter into insolvency, and an insolvency practitioner is appointed while the company continues to operate, having guarantees in place and having a seat at the table, do you find that it really does help in gaining the money back that is previously owed?
Yeah, so I mean, the more that you can prove that you're a secured creditor, whether that's a guarantee or whether that's a security interest, those negotiations or those discussions put you, I guess, up the scale as far as your discussions with the insolvency practitioner. Also, what product you might be supplying them. We've had insolvency in the past where if you're a key supplier to ongoing trade, normally you can negotiate a little harder with the administrator or the insolvency practitioner. So yes, all of those factors when you have your discussions, or you're asking for a stock take, or you're proving that you've got these different securities in different ways, make sure you're outlining those to the insolvency practitioner, because it will strengthen your position in negotiations.
Mm. And we've got a question here about suppliers and putting accounts on hold. Would you say that differing industries do show differing times of stop credit, or do you see it sort of averaging between the 45 to 60 days? What are you seeing out there at the moment?
Yeah, typically you would find that in manufacturing or wholesale supply, goods supply in particular, it's around that 45 to 60 days. And again, it might depend on your own appetite for risk and the pressure that you're going to put on your customers for non-payment, and also what's industry practice, whether that's in the steel or the electrical wholesale business, as an example, plumbing supplies. It might be that yes, 30 days are our terms, but it's sort of accepted practice that it's around 45 days. What you mentioned though before, Prudence, is when you identify that these trends change in a particular customer, that's when you need to be alerted so you can take appropriate action.
Yeah, absolutely. And what's your opinion, Kirk, on charging interest as part of putting debtors to put the pressure on, I suppose, for payment? What's your opinion on charging interest?
Yeah, well, if it's allowed by legislation in whatever state you might be in, or if you can, then it acts as a deterrent mechanism. Now, whether you do go ahead and actually charge that interest, or whether you're using it as a tool to say, hey, don't pay us late because we will charge interest, it's a deterrent, or it's an option for you to discuss in the event that someone pays you late.
Mm. And Kirk, we know that a lot of companies are moving on to phone interactions when it comes to collections and resolving issues. Have you got any tips and tricks around that, in regards to seeing if there's any early warning signs? Because I've got a couple of questions here where people are feeling as though they're not really getting back to them on time, and that makes them feel a little bit insecure as well.
Yeah, no, absolutely. And, unfortunately, in this generation and the next generation, people are going to avoid phones like the plague. So, getting past the gatekeeper or getting onto the appropriate person and not being just handed around to different people to try to speak to about getting payment is a key issue. So once again, when you set up the account, make sure they're aware of what your rules are and how you'll be chasing them or following them up if they're not paying on time. And I really do think that automation process, which is becoming more and more common now, and the early bird gets the worm. I can tell you, if you're out there being the squeaky wheel and that customer knows that on day one overdue, they're going to be getting a letter from you. And if it gets to 45 days, you'll be getting a collection notice from us. If you set those boundaries early and they get to them in writing, they're not going to they're not going to avoid you. You won't be annoying them if they know that they're your rules. And I think again, it's about your process and getting that right and making sure you've got the best possible way of getting to the right people to get that recovery. Quite often we send a letter for a collection notice that's 72-hour demand. We get paid the same day. If it's done early enough, sometimes it just requires that third party nudge to say, hey, we're serious about this if you're not paying us. The people who go, you know what, we'll give them another 2 weeks, we'll give them another month. Unfortunately, they're the ones that they're going to not pay into the future because they know they can get away with it.
Absolutely. Education is the key with a lot of these things. And with collection services, of course, you can collect against suppliers and your debtors, can't you? It doesn't need to
Yeah,
be one or the
absolutely.
other.
I mean, it depends on wherever you've got a debt. If someone becomes overdue, use the tools available to you. Just make sure that they're aware of the circumstances, that if they don't pay on time, these are the rules that you'll be following and the actions you'll be taking.
In regards to voluntary insolvency, there's two questions for this. Can you further explain what that looks like and what actually happens in that proceedings?
Yeah, so I mean, essentially, if a director puts up their hand and say, "Hey, I can't meet my debts as they fall due," they want to protect themselves into the future against insolvent trading as a director, because if they do that on purpose and they know they can't meet their debts as they fall due, then they become personally liable if a liquidator comes in and says, "Hey, you were trading whilst insolvent. So whilst you had the corporate veil that protected you from those scenarios. If we can prove that you did that on purpose, then we'll be taking action against you as a liquidator for insolvent trading, and then your personal assets as a director are on the line." So that, I guess, tries to encourage directors to put up their hand early and appoint a voluntary administrator to work out the best way forward in that scenario, to speak with creditors, to speak to their secured creditors, and possibly work out a way forward, whether that's, hey, we need a bigger repayment plan with the ATO, which is sort of the common driver at the moment for directors putting their hand ups. And then also going to their creditors, unsecured creditors, and say, "Look, I can't pay you in full, but I can pay you 50 cents in the dollar or some under a deed of company arrangement." And that's for then the unsecured creditors to decide what's going to happen with that business afterwards. I hope that's answered the question.
Yeah, absolutely. Thank you. In regards to the PPSA, I've got an interesting question here, which I did see coming up when I suppose the PPSA was first incepted. But one of the participants has said that they've started registering, but they're getting a lot of requests from clients to remove it. They're seeing CBA in particular insists that we do not require the all-PAP, and the clients are advising that they have to close the account if we don't remove it. Is there any suggestions that you can make in regards to managing this particular situation?
Yeah, correct. You don't have to follow that or do what you're being instructed, to be honest. If they are a customer of yours, your security interest is only over your goods.
That's right.
So a financier under Section 64, when they come in and they say, "Hey, we now have a debenture, or we're funding this business, we want you to remove your security interests because we have, I guess, a guarantee over the whole business assets, including the debtors ledger. We don't want you to have that anymore." Well, in fact, you don't need to do that, because you're the owner of those goods. And in your terms of trade, you've said to that customer, "Hey, we're going to register security interest because we want our goods." You're not putting a registration on the business overall. You're only putting a registration over the fact that you own those goods until paid for. So look, we do get a lot of questions around that, and it's quite common. It's a standard letter that financiers send out. There may be times where the customer is selling that debt or the debtor's ledger onto a funder, and in that scenario, they would be looking to try to remove any security interest over the goods, because that's what the funder security is. But you don't have to do it.
And I've also seen that it can be a lack of education also from the financiers, where they just don't understand that it doesn't change their position. So I have had quite a few conversations with financiers about that. So if you do need our assistance in explaining that further to them as a third party, we're happy to do so, of course, for you.
Yeah,
I know
absolutely.
that we are watching the time, and I am very conscious of that. We do have a lot of questions here. Some of them I won't be answering today, or I won't ask Kirk to answer, because some of them do require a little bit further answering than just a one-liner. But certainly we will consider doing some more around preference payments. We can certainly send out some more information in regards to collections and payment automations. Absolutely. In regards to credit references, Kirk, When NCI does this as completing a credit application form, do you usually request that with a credit recommendation to occur? Are we doing it with our credit recommendations at the moment?
Yeah, it depends on what the requirements are of a particular policy. So I guess as a minimum, what we're looking at when we do assessment is what is your discretionary limit terms and conditions require you to do. We will be looking at what we need to do to satisfy in the event of an insolvency that you've justified the credit that you've been granted. Obviously, we go a step further that if we already know a lot of the suppliers to that business, and typically we will have on file who we know are already supplying them. We have the ability to ring them up and say, hey, how are you tracking with this customer? Are they paying on time? And that's how we get our references, essentially through our network, rather than just having to send out letters to different other suppliers asking. And look, I guess in the last 5 or 10 years, references have become a little less available. People just don't have the time to complete them. So relying on bureaus or networks or businesses who have access to that sort of data is becoming even more important.
Absolutely. Another question here that's quite interesting is if a director has signed a director's guarantee and then states they will not be trading anymore, can we still collect against the director?
Yeah, absolutely. If you still have a debt that's outstanding, and they've signed a guarantee in relation to those goods or the debt that they are happy to repay, if the company is no longer paying for it, you can go after the director. I mean, the other side to that is sometimes directors change in a company. If you have a guarantee from one of the directors, hence what you talked about before, we'll alert you through if we're monitoring it, we'll alert you if the directors change. And if you note that you have a guarantee from that director, they might ask you to remove it. Or you might say, well, I'll remove it once the debt that related to your time as a director is paid. And sometimes directors removing themselves from a company is a bit of a telltale that something's not going all that well.
Absolutely. There's quite a few questions about retentions. I'll just quickly answer that. Trade credit insurance can cover retentions depending on the clausing and wording that is from the insurer. That's correct, Kirk?
Yeah. Yes, correct. So, I mean, typically most retentions are for 12 months and they're either going to be 5 or 10%. So as long as we declare that on a proposal form up front and that we ask for the clause to be added to the policy, it will cover that.
Okay. In regards to old credit application forms, someone's written in and said that we've got customers from 2015 who signed old credit apps. We've changed it a couple of years ago, including our T's and C's. Do you think that they should sign a new one?
Yeah, so there's a number of ways to think the path here. You know, one is to, when you do change your terms and conditions, that you're writing out to your customers and basically saying, if you're going to continue to order from us, the next transaction that you do with us is essentially accepting the new terms and conditions that we've put in place. Obviously, getting new credit application forms signed every time you make a change would be preferable. But in business, sometimes that's just not palatable. You just don't have the time to do that. So ensure that when you do make a change, that it's sent out to your customers. Now, in the olden days, we'd put a notice in with a statement or the invoice in the mail. You might want to just do a mail out now. But you need to ensure that in the event that something happens into the future, that you sent them a notice and that you are able to prove that they accepted it by either the next order or there was some sort of acknowledgement to that email.
Absolutely. Now we've gotten on to time, Kirk. It has been an hour, so I do know that we've got quite a few people that I'm sure would love to have lunch and do other things.
We've got more time. We can keep answering questions. People can drop off if they're not interested anymore.
And if you do drop off, I mean, I would like to mention, of course, as Kirk said, you will get a copy of this recording. Any questions that we think need a little bit further detail, we'll be writing to you as well. So if I am skipping through your questions, because we're going to write back with a few more details. But in regards to debts itself, when an administrator is appointed, does the administrator then own the debt? Is that where the debt is sitting?
Well, no, not really. So the debt still sits with the company that you were trading with. The administrator's role is to facilitate the best way to get recoveries and work out whether that business is going to be effectively able to trade on through a deed of company arrangement, or and get handed back to the directors. You still have a debt. So if it does fail and then they liquidate it, that debt links to the company, and that's where we can claim under an insurance policy. And that's effectively an insolvent act has occurred, so we can lodge a claim under the policy. Or if you don't have a credit insurance policy at that point in time, you would have to write the debt off.
Excellent. And Kirk, I've got someone here that said they did have PPSR in a company. The administrators got appointed. Business then got sold, but they never lifted their PPSR registration, but they never got paid. What do you think that they should do now?
Well, I mean, essentially that is a discussion that they should have with the administrator, because at the time of selling those goods, it was with a particular customer, and when they went to on-sell that business, there should have been a stock take, and if those goods were still there, then you were entitled to recover your goods or get paid for them. So look, I mean, I'm not a lawyer, but that's sort of what I've experienced in the past. And, someone like Paul Miller might be able to have a scenario that he's had before for a PPS scenario like that with an administrator that he'd be able to give us some more advice on.
Yeah, absolutely. That's a good point. Paul is just a wealth of knowledge. And Kirk, if a debtor goes into liquidation and they have an outstanding debt with the particular creditor, but the remaining asset that they hold has actually been paid for, can they still take back the asset, or only the ones remaining unpaid?
Yeah, so if title has changed through your agreement, meaning they've paid you for goods that you've supplied, then they're the owner of those goods.
Do you feel, Kirk, that there's any issues with having a digitally signed director's guarantee on a credit application by using Adobe or DocuSign?
Yeah, again, this is one of those questions that get debated a lot. I mean, I think it's becoming more and more common and acceptable for digital signatures. And the fact, again, that, the courts would love to see wet signatures in the event that, we can say that person is that signature, it's a wet signature. But, again, it's really important to have that double check, that you'll be able to say, yeah, you signed this. We wrote back to you and said, thank you for your guarantee that you signed to that person. And then, it's sort of, well, we wrote back to you. You didn't say, hey, I didn't sign it at the time, so therefore, why are you saying that now?
Absolutely. Look, I think that's about all from us at the moment. There's quite a few questions that are still open, but as I said, I think it's best that we write back to these with a bit more further details and steps. What it comes down to, guys, with a lot of these things is communication. If you're worried about any of these things, whether it comes from opening the account, how to monitor, how to check the account, add security, go into collections, legals, we're here for you. And certainly I'd love to be part of the brain trust of your business to be discussing these matters. So please do reach out to Kirk or myself, and we'll be able to better bespokely answer these questions for these particular situations.
And also, I noticed that some people have said, I've missed seminar 1 or 2. I'd like to see that again. Yeah, we definitely can send out the recording for those and give you the pack. It was all free. It was all our way to sort of say thank you to the credit industry, and to try to say these are some expert tips that we've seen over the last 40 years and best practice. And again, if there's anything that we can help you with, we have offices all around Australia and New Zealand, Singapore and Malaysia. If you need someone to pop out and see you to discuss any of these factors, or pick our brains on what's best practice, then we'd be more than happy to help you.
Absolutely.
Oh, thanks, Prudence. That's been fun.
It has been fun. We might do some more next year, I think, with the amount of questions that we've got.
All right. Thanks, everybody, for tuning in. I hope you have a wonderful year, the remainder of this year. And again, if you've got any further questions or you want any more information, please reach out. Bye for now.
Excellent. Thank you. Bye.